Hi, Mark Anderson here, mortgage banker at Paramount Bank. I do lend in all 50 states, so I'd love the opportunity to earn your business. For today's rate update, I am reporting to you from the home front. I moved into the home office today, as I'm sure a lot of you have recently made that transition yourself. I hope everybody is safe and well out there. Today in the bond market, we had some good news. So as I had hoped, I'm not going to say predicted, because I did not necessarily predict it, but I was hoping that the momentum we saw on Friday would carry through to today, and it did. We had much better pricing today across the board. I had a couple people that were on my list of folks that kind of felt like they missed the boat a few weeks back when the rates first got low. I was able to get them locked in right away. They did take my advice of actually filing their application with me up front, which made it very, very easy and very, very fast to get their rate locked in. They didn't have to sit on the phone with me and answer a million questions. I didn't have to take the time to pull a new credit report, run an analysis of their ability to qualify. I was able to just, with them on the phone, say, this is the rate. Do you want the rate? Let's lock it. Boom, done. So there is an advantage to that. Now, the opportunity today, where did it come from, and what does it look like, and what's going to happen going forward? What it looks like is that the Federal Reserve has made a very, very strong, open-ended commitment to solving, or at least helping to stave off, something that some people are calling the liquidity crisis, the liquidity crunch, and basically this is what that means. Generally speaking, when the stock market has a bad day, that's a good day for mortgage bonds, and it's a good day for rates. I generally tell my clients, hey, if you want like a basic indicator of when rates are getting better, look for the stock market to have a bad day. That's based on this idea of something called the flight to quality. So when people move their money out of stocks, when the stock market's going down, they want to move it into a safer investment, which is found in these long-term safe bonds. Now, in this case, what we've actually seen is another step in that flight to liquidity. They've gone from stocks to bonds, from bonds to cash. And that's pulled a ton of cash out of the mortgage bond market. So basically what the Federal Reserve has come in and said is that, look, we're not going to tell you in advance what our limits are. We are just going to do what it takes. So they've made a very open-ended commitment to just inject as much money as is needed to fulfill the demand inside this market. So that good news really propelled the already kind of good feelings in the market, in the mortgage bond market, pushed those up, and we saw much better pricing today. Now, this is just an illustration of how crazy and volatile things still are, though, because right as I'm on the phone with a client about to lock their rate, I get a notice that we've seen the bond drop here. This is a massive, massive drop in bond prices. And normally, on any normal day, that would have spelled disaster. We would have seen lenders across the country making midday price changes for the worse, but they didn't. They didn't react. And then the bond prices came up. So we ended up avoiding what would normally be a really scary situation, and we've had really favorable pricing throughout the day. Now, that volatility has resulted in, let's see, 17 lenders nationwide have made their rate sheets better from this morning. 12 have made them worse. There is volatility. Now, that's just based on what pricing they came out with this morning. Where do we go from here? Well, if there is a signal as far as what's going to happen tomorrow, we've got it this afternoon. Because as you can see here, bond prices have fallen off their highest levels of the day. This may be for any number of technical reasons. It could be some just capacity in the market getting gobbled up, and basically, this phenomenon I've talked about multiple times, that there's only so much capacity that the market has. So maybe that got full. There could be any number of other things influencing this, but the name of the game really is volatility. And from one day to the next, from one hour to the next, from one 30-minute window to the next, it's really impossible to tell what this market is going to do. So if you were thinking about refinancing, and if you have already not talked to your favorite loan officer guy or gal, I would reach out and make contact, because today we've got better pricing than we've had in quite some time. If you went under a purchase contract, let's say you were in the unenviable position of going under a purchase contract last week, you may have locked in at rates that were significantly higher than they are now. So you might want to look at your options there. But again, better pricing today. I'll be anxious to see what happens tomorrow. I'm happy to look at any of your scenarios, whether it's for a purchase or a refinance anytime. I have heard actually from quite a few folks from these videos, so I really appreciate that. It means a lot to me, and I look forward to talking to you in the future. Thank you.